level, we've not really moved so much in percentage terms, but to think of it, we're all at that 24,500 mark, and that's a near about 8.5% recovery that we've seen on the Nifty alone from those March lows. Well, today the pressure points continue to be Trend, L&T, there's a Reliance, ICICI Bank, BEL, which are not participating in today's move. But look at technology. That's really come to the fore across the market cap categories. Bajaj Finance has been holding strong. There's Swiggy, there's Eternal, there's the JSW Steel, Bharti, as well as Maruti, which are all holding up in the green. And today you're seeing a minuscule move from HDFC Bank and Axis, much unlike yesterday, wherein Axis was actually a rank underperformer and HDFC Bank one of the key performers on the index. So that's looking good. And yes, the breadth of the market is tilted towards declines. I mean, look at the quantum of losses, for instance, on a Trend that's down 12% right now. Kalyan Jewellers is down 7%. MCX is lower by 3.6%. And then BSE as well, which is down about 3.25% as we speak. But what's the way forward for the equity markets? We've got Jyoti and Jaipuria joining in on the show to answer exactly that. Jyoti, great to have you on ET9 today.
Hi.
Thank you so much for your time. You know, we were just discussing earlier today that from March lows, it's been a fabulous recovery that's already taken place. And now you've got the comfort factors coming in on crude as well, which is sizably lower from where we were during March period. What next, Jyoti, in terms of a trigger for the market?
Yeah, so, I guess from March, when we look at it, we obviously have to think that March was a very bad month, and to that extent, a lot of recovery, which you've seen, correcting the March loss. But I think the big move has been really, if you've seen the small caps, not so much in the large caps as in the small and mid cap. The small cap index is up, I think, 20 odd percent, and the mid cap is also up, high double digits. So we've seen that recovery. I think, from our point of view, that 2-3 things which continue to be positive. One is, I think earnings will recover. So we've had 2 years where earnings have grown at 5%. And, this year, I think we'll get earnings growth in double digit. Next year also will be double digit. I think next 2 years, probably instead of 5%, we are going to see earnings grow at around 15%. The second is, as you said, oil. Oil coming back has restored our macro. Because, in March, everybody was worried about the macro stability. And that part is again behind us with oil at level.
Well, we seem to be on a very patchy line with Jyoti. Blame it on the Mumbai rains. We'll pick up on that conversation going forward as well. Kunal, do you sense that small caps and mid caps will continue to outperform the benchmarks going forward as well? Or is there a case now of perhaps large caps doing better in the next lap?
No, I think it should be synchronized. I think it should be mid caps and small caps trying to show signs of outperformance. So, what happens is that the last 800 points or the 1,000 points of the Nifty is where the market sentiment has become a little better. However, we've still not gone to that strong risk on appetite mode for the indices. That generally happens once we break past about crucial resistances for the index. Say, for example, 24,500 being one of the critical resistance or the mark for the index, but the bigger breakout could be at 25,000 mark. Once we break past about these strong psychological levels, is where the risk on appetite comes back, and that's why you see heightened activity. To start to look out for more of alpha generation, and in that scenario, I think the mid caps and the small caps they tend to outperform. So I think for someone who's looking at building a short-term trading portfolio, if being bullish on indices and expecting a breakout of the 25,000 mark, then I think the mid caps and small caps will stand to outperform.
Now, Kunal, what Jyoti was also mentioning. The small cap has gone up by nearly 21% in the last 3 months, the mid cap by 14%, and the Nifty 550 by only 5.5%. That kind of outperformance which we have seen in small cap, is that also because the kind of fall was also extreme for small cap?
Yeah, because the sell-off was very extreme. So, you look at the correction for many small cap and mid cap names from the 2024 highs. An average correction was around 30 to 40% for many of the small cap and mid cap names in the past 2 years or 1.5 odd year approximately. Now, in that time span, when you look at the indices also, the indices went through a very sharp phase of correction. Now, in the phase of recovery, it's because these stocks were sold off significantly on the much steeper side, on the downside, is where you've seen these stocks, as well as the small caps and mid caps, seeing a very sharp bounce back. And that's one of the major reasons why you've seen the mid caps and small cap indices hitting hitting the respective multi-month, multi-quarter highs much prior to the benchmark indices. Case in point, one more index which has also come back closer to its multi-month high is the Nifty Next 50. So you look at the other set of large cap names, the tier 2 large cap stocks. Even that index has come back into a good 20% recovery from its previous lows of 60,000 approximately. So that tells you that the market construct has been more towards mid caps, small caps, and the tier 2 large cap names, and that's where I think the tilt should continue.
Okay, Jyoti Jaipuria is back with us. Jyoti, apologies for that bad connection. Perhaps it's because of the rains. But yes, you were telling us what triggers is the market going to be looking out for going forward?
Yes, I'm not sure where we got cut off. So one is the earnings recovery, which I think over the next 2 years would be more like 15% from the 5% we've seen recently. Second is if you look at the macros, in March, there were a lot of worries about the current account deficit and then the currency weakened as a result of that. With oil having come down, the macro worries now are easing off and macro starting to look good. Especially now, once they get the FCNR coming through also, that will start boosting our forex reserves also. And third is, the FIs have been big sellers in the market. If you see, they've been crazy sellers. I was in, US and then in Hong Kong a couple of weeks ago. So in general, most people are underweight India. So, there's a positive and negative to it. The way I'm looking at it is it's a contrarian indicator. Most people have given up on India now. I think the immediate trigger for them will be not so much the earnings recovering as much that there is a worry on the AI stocks, there's a worry on the chip stocks in South in South Korea. And, to that extent, people may say, okay, let's cut down India's underweight a bit. India is today the largest underweight it's ever been in the last 25 years for FIs. So to that extent, there's extreme positioning away from India. And I think we'll probably see some of that getting reversed. I don't think we'll have, they're getting overweight, but at the same time, probably people will want to cut their underweight a bit. And that may mean that FI outflows will be lower than what we've seen over the last 6-8 months.
So you play the India basket through financials, or are there any other sectors that you are also looking?
So, we play a mix. So we like financials. It's, one of the important sectors which we like. The other thing which we like in a big way is the pharmaceutical and the healthcare space. So that is again something which we are usually overweight with. The third thing which we are playing is, a broad mix of auto ancillaries and capital goods, which, generally I club under one as, the manufacturing setup. What we are underweight on in a big way is still IT. And that continues to be underweight. And the other thing is the consumer staple space.
Is there a specific pocket within pharma? Means only the export side you're looking at, or CDMO side as well you're looking at, or specialty chemicals in the chemical space?
So, in pharma, there are two things which we are overweight on. One is the CDMO, which you said, where, we love the space over the next 5 years. Valuations are what concerns us, but we still have some exposure there. The other thing which we have a much larger exposure on is actually the generic pharma. So if you see generic pharma for the last many years, generic prices kept coming down. And so generic pharma didn't really perform. We called the bottom of generic pharma 18 months ago, and that's where we gone hugely overweight on generic pharma companies. And our sense is the next 2 years will still continue to be broadly very, very good for this. So, that's a important space for us. Chemicals is something which actually we were not having an exposure to, but we have actually started buying now. And there are two reasons for it. So one is, stock prices have come down quite a bit. So they're not cheap still, but, at least they've become better valuation. Second is, our sense is earnings will pick up for them in a big way. So, in the first quarter, there was high freight costs, high insurance costs, which were hurting them. China on its part actually is probably going to behave a little more sensibly on prices, because what they've done is remove the export incentives which were there from April of this year. So now, that competition from China, which at some point seemed unreal, is probably not going to be there. And because of that, I think margins for a lot of these chemical companies can start picking up.
Okay, that's the take coming in pharma. In the meantime, just looking at the big strength sector today, and that's clearly IT all the way. Kunal, I just want you to come in here because, today the strength is not restricted to the large cap names, but look at a Naukri, for instance, a quasi-IT, stock in that sense. And then, persistent, emphasis, the mid-cap IT end of the market. Any trading opportunities here?
Yeah, quite a few. In fact, persistent is something which starts to look very attractive at the current levels. Even after this, 3%, 4% up move for the stock at the current juncture, I think, the stock is also on the verge of a flag pattern breakout above 4,900 mark. So maybe if once that level gets taken out, you might probably expect the stock to start to move into a trending manner in the short term. Levels of 5,100, 5,200, they start to open up for persistent from the current juncture. Coforge is on the verge of a triple top breakout. Also, I think if I'm not wrong, the stock is also on the verge of or very, very close towards its 200 moving average for Coforge. So that's another name to watch out for, because once that breakout happens, both a triple top as well as a 200 DMA breakout, the stock could surprise with a decent 300 to 200 point on the upside. So which means that we could be looking at a point where many of these stocks could be at the cusp of at least another 5% to 7% swing upside.
Okay. Jyoti, curious to know what's your take on IT, because we've seen these kind of moves many a times earlier, only to clock in fresh lows. What's the expectation in terms of what the commentary going forward could be from the IT majors when they declare their earnings starting this week?
Yeah, so we've been zero weight on IT for 3 years now, because we had got this AI a little early, more because of some of the international people we deal with and what they had explained to us. It's getting a little attractive in just two respects. One is now consensus is worried about AI trade, and so to some extent is there in the price. Second is stock prices have underperformed a long time, so that it's become cheaper. But we still for us, it would be more like maybe there's a trading opportunity at some point. But otherwise, the growth rate of these IT companies are still going to be much slower than what we've seen in the past. So I guess, when the commentary comes, people will say that they're seeing things improving a bit, but, the environment still remains uncertain for them, just given, the way AI is taking over and the developments there. So I don't think, any IT company will give us guidance which is like super bullish or something.
Jyoti, curious to know how you're reading into the quarterly updates of the entire consumption basket so far. And I'm not just talking about staples, but some of the niche urban consumption plays, the retailers, for instance, the BPC segment. Any trend that you're witnessing here, which could be a good investable anecdote?
So, to me, actually, the trend has not been so bad. It's, been fairly okay. The problem has been with a lot of these names, expectations were very high. So when you look at what they're announcing with expectation, any small misses and the stock prices fall quite a bit. So, you see it with whether it's the retail name or the jewelry name and all. Once you get like any misses relative to a high expectation, they tend to fall quite a bit. But even if you see the staple names, they have been showing growth. It's just that whether, the growth continues because of the monsoons remain edgy, and then, it's not a great agriculture season, then maybe this won't play out. And second is, like I said, just the valuations. Even if these growth rate comes at those valuations, can you really make money? Because from our point of view, when we look at risk reward, the staple space especially just offers no risk reward.
Do you think that markets don't have enough patience now? A slight disappointment and it gets punished very badly, like a trend is getting done today, or for that matter, a Kalyan?
Yes, some of these are not cheap stocks. The problem is when the stocks are not cheap, and you saw the same thing happen with, the power equipment people a couple of days ago when, Chinese players were allowed in. Because, these things, people believe that there's a very high growth rate, which, we also agree the growth rate is high. But the valuations are such that the margin for error in valuation is very low. So every time you think there's some negative news, and if suppose somebody is supposed to grow at, let's say, 25%, he grows at only 20%, then people say, okay, then I need to mark down valuation from 25 to 20. And that's the reason share prices tend to fall quite a bit.
And if you look at within the financial space, which are the segments which you like? Is it the private sector banks or public sector banks or NBFC? And if you want to just break it up more, capital goods as a theme, do you look at that as well?
So, within the banks and the BFSI space, at the moment, we are more overweight on private sector banks, but not the larger private sector, but the smaller private sector banks. We are also started to build positions in the NBFCs. So probably we believe over the next couple of months, we'll probably be overweight on NBFC than we are today. And the logic for a lot of this is just, we see NIMs come under pressure, and that NIMs are probably going to start expanding over the next 1 year as your deposit interest rates start to get repriced down. Uh, Within capital goods, it's like a very large sector. We are always hunting for two things. One is, we want growth visibility, and second is we want valuations to be a little more reasonable. So we have exposure, I would say, to the water space, which is, something which has done very well for us. And then we have exposure to the pipe space.
Okay, makes sense. Jyoti, any other overweights in the market other than the sectors we just discussed?
So, from our point of view, these are like the bulk of the sectors which we have. So, I think of like consumer discretionary as probably one, technically it's not a sector, but, when we do our portfolio analysis, we think of consumer discretionary as one space where we are a bit of overweight. So here, we have like autos, which is one of our favorite things here. So a lot of it, we are playing through the auto ancillary space because, a lot of ancillaries cater to different auto majors. And to that extent, which of them gains market share does not matter to the auto ancillary as long as the whole segment grows. Second, a lot of the auto ancillaries, because they are into engineering, they are also, starting to cater to to the defense space, to this space, that space, and you get it much cheaper than what you get, the more well-known defense companies. So auto ancillaries is one space which we find very good visibility on growth at reasonable valuations.
Jyoti, capital markets as a theme, you have SBI Mutual Fund coming out with an IPO maybe early next week, which is there. How do you look at AMCs as a whole?
So, in general, the capital market theme is very interesting because, capital markets will grow over the next 5 years. And a lot of these, the operating leverage is very high because, there are a lot of fixed costs there. So as, the top line grows is good. For us, it's probably given the way markets have behaved over the last 1-2 years. These are stories which do very well when the market is going up. When the market is flattish, then you probably start to see, some sort of consolidation happening. So at the moment, there was a point where we were very overweight a lot of these names. At the moment, we are not very overweight. We are more into the banking space and the lending space.
Jyoti,